If you woke up today, Saturday, February 7th, 2026, and checked your precious metals portfolio, you probably noticed something that felt off. Silver up, gold ticking higher. A strange kind of movement that doesn't feel like a normal market day. And if you're like most people, your brain immediately tried to explain it away. Oh, weekend pump. Maybe geopolitical tension. Maybe some Fed rumor. Maybe inflation headlines. But I need you to understand something right now. This is not a market move. This is not sentiment. This is not retail demand. What you're watching in real time is a regulatory detonation. A controlled explosion that was planned years ago, delayed for over a decade, and is now going live in less than 36 hours. And if you don't understand what's about to happen by Monday morning, you're going to get blindsided. Because Monday, February 9th, 2026, at market open, the net stable funding ratio under Basel III goes into strict enforcement for major European and U.S. banks. And I'm not talking about soft enforcement. I'm not talking about transitional compliance. I'm not talking about the same watered-down Basel headlines you've been hearing since 2014. I'm talking about hard enforcement, meaning comply or lose your license. And the part that should terrify you is this. This rule doesn't just affect banks. It affects the entire paper gold and paper silver system. It affects COMEX. It affects the London bullion market. It affects unallocated accounts. It affects synthetic ETFs. It affects futures contracts. It affects the entire illusion. And what it does is brutally simple. It takes paper silver and reclassifies it as toxic. It turns paper precious metals into a balance sheet liability. And it forces the biggest banks on earth to either back their paper positions with real capital or unwind them. Now listen carefully. For the last 15 to 20 years, bullion banks have played a game, a very profitable game. They've been able to create essentially unlimited synthetic supply by issuing paper claims on metal they don't actually have. They could short silver, short gold, roll those shorts, extend those shorts, cover them with more paper, and repeat. And because the public doesn't demand delivery, the game works. The paper price stays suppressed. The charts look normal. The mainstream media tells you it's all efficient and transparent. But it was never transparent. It was fractional reserve bullion banking, a paper system sitting on top of a physical market. And Monday morning is the day the BS forces the paper system to face physical reality. Here's what changed. Under older Basel frameworks, banks could treat unallocated gold and silver, paper claims, as low-risk assets, meaning they could hold massive unallocated positions without being punished. They could short the COMEX, short London, short ETFs, short swaps, short OTC derivatives, and the capital requirements were minimal. But under the NSFR rule going live Monday, unallocated precious metals are now treated as high volatility, illiquid assets, and they require an 85% stable funding reserve. Let me translate that into plain English. If a bank is holding a $1 billion paper silver position, they now need $850 million in Tier 1 capital sitting in reserve to justify it. Not eventually, not over time, not in the next quarter, by Monday open. Now compare that to allocated physical metal. Allocated physical gold and silver are treated as Tier 1 assets. Zero risk weight, meaning if the bank holds the actual metal, they don't need that massive capital buffer. Do you see what just happened? The incentive flipped. Overnight, paper became a liability. Physical became the escape route. And now the bullion banks are staring at their own balance sheets, realizing something horrifying. They are not compliant. And if they aren't compliant, this isn't a fine. This isn't a slap on the wrist. This is license revocation. This is being cut off from central bank facilities. This is being locked out of the European banking system. This is the financial death penalty. So what do? They do the only thing they can do. They unwind. They cover. They buy. They scramble. They convert paper to physical. And they have to do it now, before Monday. But here's the part that turns this from big news into a historic event. There is not enough physical silver on Earth to cover the paper. Not even close. Let's look at the numbers. As of Friday close, February 6th, the COMEX silver open interest sat around 412,000 contracts. Each contract represents 5,000 ounces. That is roughly 2.06 billion ounces of paper silver. Now compare that to global annual mine supply, roughly 850 million ounces per year. Meaning, COMEX open interest alone represents about 2.4 years of total global mine production. And now here comes the knockout punch. Registered silver in COMEX vaults available for delivery? Around 64 million ounces. So let's do the math. 2.06 billion paper ounces divided by 64 million deliverable ounces. That's a leverage ratio of about 32 to 1. 32 paper claims for every 1 ounce of real silver. And Monday morning, the BS is telling banks, you need to back your paper with capital or unwind it. Do you understand what that means? It means this market is not about to experience a squeeze. It's about to experience a systemic failure. Because there is no way to reconcile paper promises with physical scarcity at this scale without price explosion. Now, before I go further, I want you to do something. Hit the like button right now. Not because I care about engagement, but because I've seen this happen before. Whenever information like this starts spreading, the algorithm buries it. The system doesn't want retail investors understanding what's about to happen. Because if retail understands it, it becomes uncontrollable. So hit like now, and stay with me, because I'm about to explain what you saw on Friday afternoon and why it was the first visible crack. Friday, February 6th, at around 2:47 p.m. Eastern, silver suddenly spiked in minutes, and the mainstream financial media immediately jumped in with their scripted excuses: geopolitical tension, retail demand, inflation fears, speculative momentum. That is not what happened. That was a cover story. What actually happened at 2:47 p.m. was the first wave of algorithmic short covering from European banks. The banks weren't buying because they wanted to. They were buying because they were forced to. And I can prove it. Because when you look at the volume data, you see block trades that no retail trader could ever execute. At around that same time, SLV, the largest silver ETF, saw a massive block trade. Millions of shares. Institutional size. Not a guy on Robinhood. Not a YouTube viewer buying 2 ounces. This was balance sheet panic. And it continued into the close. Because the banks realized the deadline wasn't coming in a month. It wasn't coming next quarter. It was coming in 72 hours. Now here's the trap they're in. The banks have 3 options. And every option destroys them. Option 1. Cover their paper shorts. They buy back futures contracts at market price. But if they do that at scale, the price goes vertical because there is not enough liquidity for that much forced buying. Option 2, take delivery. Convert unallocated to allocated. But the physical doesn't exist. There are only tens of millions of ounces available, and they need billions. Option 3, raise Tier 1 capital. Sell other assets. Issue bonds. Beg for liquidity. But if they do that, they reveal their weakness. And weakness in a fragile system triggers bank runs. So the banks are trapped. No clean exits. Every move leads to the same outcome. Silver explodes. And here's why this isn't just about silver. This is about the dollar-based financial system itself. Because the BIS doesn't enforce rules like this randomly. They enforce rules like this when they know the system is unstable. They know the treasury market is showing cracks. They know commercial real estate is imploding. They know derivatives exposure is still a ticking bomb. They know the Fed's balance sheet is still bloated. They know global debt is unsustainable. So they're doing something that sounds technical, but is actually historic. They're forcing banks to hold real assets, not paper leverage. And that's why precious metals suddenly matter again. Because in 2019, something else happened quietly. The BS reclassified physical gold as a Tier 1 asset, equivalent to cash. And nobody cared. Mainstream media ignored it. But central banks did not ignore it. Central banks saw the message. And they started buying. Massively. Year after year. Thousands of tons. China, Russia, India, the BRICS bloc. They were front-running this shift. They were positioning for a world where paper claims lose credibility and real assets become the foundation of the next system. Now I want you to do something else. Go to the comments and tell me what you're seeing at your local dealer. Because I already know what's happening. Physical premiums are exploding. Silver Eagles? Sold out. Maple Leafs? Gone. Generic rounds? Backordered. And the dealers aren't saying, maybe next week. They're saying weeks. Because here's the truth nobody wants to say out loud. The spot price on your screen is the paper price. It's the fake price. The real price is what you pay for physical. And that gap is about to blow open so wide that the public won't be able to ignore it. Now let me expose the real villain in this story. It's not a president. It's not a political party. It's not even the Fed directly. The villain is the algorithm. For 15 years, the silver market has been suppressed by high-frequency trading and paper dumping. You've seen it. Silver drops $1 in 90 seconds with no news. Gold gets slammed in a straight vertical line. The explanation is always volatility. No, it's spoofing. Spoofing. Synthetic sell pressure. And yes, it's illegal. But the fines are nothing compared to the profits. So the banks did it anyway. Every day. For years. But the algorithm only works when the banks can create infinite paper supply. Basel III in CFR removes that ability. Because now every new paper position requires massive Tier 1 capital. So the suppression mechanism breaks. And when the suppression breaks, silver doesn't just rise. It reprices. Now, think about history. Gold confiscation. Why? Because the banking system was insolvent. People demanded physical redemption, and the paper system collapsed. So the government forced gold into state hands and revalued it. Wealth transfer. Nixon closes the gold window. Why? Because the U.S. issued more dollar claims on gold than it actually had. Foreign governments started demanding redemption, and the game ended. Gold went from $35 to $850 because paper claims had to face physical scarcity. And now, silver is at that same inflection point. Fractional reserve silver banking has created tens of billions of ounces of paper claims on a physical market that simply cannot deliver. And Monday morning, the BS is forcing the system to reconcile. Now let's talk about the next 72 hours. Right now it's Saturday night. Markets are closed, but banks are not sleeping. I guarantee you, there are emergency meetings happening right now at JP Morgan, Citi, HSBC, Deutsche Bank. They are calculating NSFR ratios. They are checking exposure. They are scrambling to avoid non-compliance. And Sunday night, when futures open, that's when the real fireworks start, because the banks will begin covering. And covering in a thin overnight session means price gaps, violent moves. You could see silver jump from $31 to $35 to $38 before most people even wake up. Then London opens. More covering, more panic. Then New York opens. And the entire world sees it. And once the world sees it, retail piles in, hedge funds pile in, sovereign money starts moving. And the move becomes self-feeding. But here's the wild card. If even one major bullion bank declares force majeure, if even one major exchange says delivery can't be met, the paper market collapses. And when paper collapses, price discovery shifts to physical. And in the physical market, the price is not what a chart says. The price is what the seller demands. And if nobody sells, the price goes wherever it has to go. $50, $60, $80, $100, even higher, because the market is forced to find the level where supply comes out. And in a market this small, that level can be shocking. Now I need to be crystal clear. This is not financial advice. I'm not telling you to panic. I'm not telling you to sell everything and buy silver with a credit card. That would be reckless. What I'm telling you is that we are at a real inflection point, a deadline, a hard date, a rule change that forces the biggest players to unwind positions they've held for years. And those kinds of events don't happen often. But when they happen, they reprice markets permanently. So what should you do if you don't own physical gold or silver? This weekend might be your last calm window. Not because the world ends Monday, but because the market structure changes Monday. And once the structure changes, availability changes, premiums change, delivery times change, dealer inventory disappears. And by the time CNBC admits something is wrong, it's already too late. If you already own physical, do not let a short-term spike trick you into selling early. Because what's happening isn't a quick pump. It's a structural reset. It's the end of paper dominance and the beginning of physical reality. And when that transition happens, the people holding real metal will realize something. They weren't speculating. They were positioned. Now I want you to think about one final thing. The BIS isn't doing this to save the system. They're doing this to reset it. Because the current debt-based system is terminal. The numbers don't work. The debt can't be repaid. The derivatives can't be unwound cleanly. The trust is collapsing. So they're forcing banks to hold assets with intrinsic value. And they've been preparing for this for years. Central banks buying gold wasn't random. It wasn't diversification. It was preparation for a world where paper promises mean less and real assets become the foundation of the next system. So here's the reality. The banks are not sleeping tonight. The regulators are not sleeping tonight. And the smart money is not sleeping tonight. They are preparing for Monday morning. Because Monday morning, the paper market meets the wall. And the wall is physical scarcity. If you want updates as this unfolds, subscribe with notifications on. Because the next 72 hours could move faster than anything you've seen in years. And I will be here tracking every development in real time. This is John CC. And Monday is going to be wild.